Question 1. In Illinois, long-term care insurance policies must follow specific guidelines regarding benefit triggers. Which of the following options correctly identifies a common benefit trigger used in long-term care policies? A. The policyholder must have a diagnosed terminal illness. B. The policyholder must have difficulty performing at least two activities of daily living adults. C. The policyholder must have a high medical debt from unrelated health issues. D. The policyholder must be over the age of 75. Answer: B. The policyholder must have difficulty performing at least two activities of daily living adults. Explanation: the Illinois long-term care insurance regulations specify that one of the most common benefit triggers is the inability to perform at least two activities of daily living adults, such as bathing, dressing, eating, transferring, toileting, and continence, or having a severe cognitive impairment. This trigger is a critical threshold for policyholders to start receiving long-term care benefits. Options A, C, and D do not meet the specific criteria required to activate long-term care benefits under most Illinois policies. The terminal illness trigger is more associated with life insurance or critical illness coverage. And unrelated medical debt, C, or age alone, D, are not considered valid triggers under long-term care policies. Illinois Insurance Code. Long-term care policies. Question 2, scenario-based. Mr. Thompson, age 65, is considering purchasing a long-term care insurance policy in Illinois. He has a family history of Alzheimer's disease and is particularly concerned about covering costs if he develops cognitive impairment. He is looking at two policies, one with a lower monthly premium but no inflation protection, and another with inflation protection built in, though the premium is higher. Mr. Thompson expects to need the policy benefits 15 to 20 years from now. What should Mr. Thompson prioritize in his decision? A. He should choose the policy without inflation protection, as premiums are lower and cognitive impairment will be covered regardless. B. He should choose the policy with inflation protection, as it will ensure his benefits keep pace with future care costs. C. He should purchase both policies to maximize coverage in all scenarios. D. He should avoid purchasing either policy until he is diagnosed with a condition that triggers long-term care needs. Answer: B. He should choose the policy with inflation protection, as it will ensure his benefits keep pace with future care costs. Explanation: given Mr. Thompson's concerns about developing cognitive impairment in his long-term planning horizon, the policy with inflation protection would be more suitable. Long-term care costs are expected to rise significantly over time, and policies without inflation protection could lead to inadequate coverage when he needs care 1520 years from now. By opting for inflation protection, Mr. Thompson ensures his benefits increase in line with rising healthcare costs. The other options are less suitable. A. Lacks necessary inflation protection. C. Purchasing both policies would be unnecessarily expensive. And D. Waiting until diagnosis may make him uninsurable. Illinois long-term care insurance regulations, mandatory consumer protections. Question 3. Which of the following best describes the purpose of the Illinois Long-Term Care Insurance Partnership Program? A. To offer discounted long-term care insurance policies for individuals below the poverty line. B. To encourage consumers to purchase long-term care insurance by allowing them to protect a portion of their assets from Medicaid spend-down requirements. C. To provide automatic eligibility for Medicaid once a long-term care policy runs out of benefits. D. To allow employers to offer long-term care insurance as part of their group health benefits. Answer: B. To encourage consumers to purchase long-term care insurance by allowing them to protect a portion of their assets from Medicaid spend-down requirements. Explanation: the Illinois Long-Term Care Insurance Partnership Program is designed to incentivize individuals to purchase long-term care insurance by allowing them to protect an equivalent amount of assets from Medicaid's asset spend-down requirements. This means that for every dollar paid out by a qualified long-term care policy, an individual can keep an additional dollar of their assets when applying for Medicaid. This helps policyholders preserve more of their savings while still qualifying for Medicaid coverage once the long-term care policy benefits are exhausted. Option A is incorrect, as the program is not designed for individuals below the poverty line. Option C is inaccurate because Medicaid eligibility is not automatic. It still depends on meeting financial and other criteria. Option D is irrelevant, as the partnership program is aimed at individual policies, not employer-based group insurance. Illinois State Partnership for Long-Term Care Insurance Program. Question 4. In Illinois, which of the following statements is correct regarding the waiver of premium rider commonly found in long-term care insurance policies? A. The policyholder continues paying premiums even after they begin receiving long-term care benefits. B. The policyholder must apply for Medicaid before the premium is waived. C. The policyholder's premium payments are waived once they start receiving benefits after satisfying the elimination period. D. The waiver of premium applies only if the policyholder is permanently disabled. Answer: C. The policyholder's premium payments are waived once they start receiving benefits after satisfying the elimination period. Explanation: the waiver of premium rider allows a policyholder to stop paying premiums after they begin receiving long-term care benefits, provided they have satisfied any elimination or waiting period specified in their policy. This feature helps reduce financial burden on the policyholder during times when they are already paying for long-term care services. Options A, B, and D are incorrect because the rider automatically waives the premium once the policyholder qualifies for benefits. It is not dependent on applying for Medicaid or being permanently disabled. Illinois Insurance Code. Long-term care policies. Question 5, scenario-based. MS. Davis is a 72-year-old widow living in Illinois. She recently purchased a long-term care insurance policy with a $200 daily benefit and a 3-year benefit period. After 2 years of home-based care, her care costs increased to $250 per day. MS. Davis is worried that her insurance benefits might not cover her costs if they continue to rise. What option would have been best for MS. Davis to include in her policy to address this issue? A shorter benefit period to reduce premium costs. B. Inflation protection to increase the daily benefit amount over time. C. A shared care rider to allow unused benefits from another policyholder. D. A lower daily benefit to reduce her overall premium cost. Answer: B. Inflation protection to increase the daily benefit amount over time. Explanation: MS. Davis should have considered inflation protection when purchasing her policy. Inflation protection adjusts the daily benefit amount over time to account for rising care costs. Without this protection, her $200 daily benefit will remain fixed while the cost of care can continue to rise, leaving her responsible for her out-of-pocket expenses. They and D are incorrect because reducing benefits would not help her cover increasing costs. C is not relevant because a shared care rider typically applies when another policyholder's benefits are involved. Illinois Insurance Code. Long-term care policies. Inflation protection options. Question 6. Which of the following factors most significantly influences the premium calculation for long-term care insurance in Illinois? A. The policyholder's credit score. B. The policyholder's marital status and health condition. C. The policyholder's employment status. D. The policyholder's location within the state of Illinois. Answer: B. The policyholder's marital status and health condition. Explanation: long-term care insurance premiums are primarily determined by factors such as the policyholder's age, health condition, and marital status. Marital status can affect premiums because couples may be eligible for shared care riders or discounts. Health condition is a significant factor, as individuals with pre-existing health issues might face higher premiums or be declined coverage. A, C, and D are incorrect because credit score, employment status, and location within the state do not directly impact premium calculations. Premium calculation factors. Illinois long-term care insurance. Question 7. In Illinois, what is the primary benefit of purchasing a hybrid long-term care policy compared to traditional long-term care policy? Hybrid policies generally offer higher monthly benefits than traditional policies. Hybrid policies combine long-term care benefits with life insurance or annuities, allowing unused long-term care benefits to be passed on as a death benefit. C. Hybrid policies do not require medical underwriting, while traditional policies do. D. Hybrid policies allow the policyholder to claim benefits immediately without an elimination period. Answer: B. Hybrid policies combine long-term care benefits with life insurance or annuities, allowing unused long-term care benefits to be passed on as a death benefit. Explanation: hybrid long-term care policies offer a combination of long-term care insurance with either life insurance or annuities. If the policyholder does not use all of the long-term care benefits, the remaining benefits can be paid out as a death benefit to beneficiaries. This feature makes hybrid policies attractive to individuals who want to ensure their premium payments are not wasted if long-term care benefits are never used. C and D are incorrect because hybrid policies do not necessarily offer higher benefits, still may require medical underwriting, and typically have elimination periods similar to traditional policies. Hybrid long-term care policies. Illinois insurance regulations. Question 8, scenario-based. Mr. Garcia, 60, has just been diagnosed with early-stage Parkinson's disease. He currently has a long-term care insurance policy in Illinois with a daily benefit of $150 and a 5-year benefit period. However, his policy does not include a non-forfeiture benefit rider, weighs the potential risk of not having this rider in his policy. A, he may lose his coverage if he can no longer afford the premiums. B, his coverage will expire once he turns 70. C, he will be unable to receive benefits unless he is in a nursing home. D, his coverage limits will decrease as his condition worsens. Answer: A, he may lose his coverage if he can no longer afford the premiums. Explanation: the non-forfeiture benefit rider ensures that if Mr. Garcia can no longer pay the premiums, his policy will not lapse entirely. Instead, he would retain a reduced benefit based on the premiums he has already paid. Without this rider, he risks losing his coverage entirely if he is unable to continue paying premiums, particularly as his condition progresses. The other options are incorrect because B, there is no automatic expiration at age 70. C, the policy likely covers various types of care, not just nursing homes. And D, coverage limits do not decrease as his condition worsens. Illinois Insurance Code. Long-term care policies. Non-forfeiture benefits. Question 9. Which of the following is a key ethical consideration for agents selling long-term care insurance in Illinois? A, selling policies with the highest commissions to maximize profit. B, ensuring the consumer understands the full policy terms and suitability before purchase. C, recommending the most expensive policy to increase the agent's commission. D, encouraging consumers to cancel existing coverage and purchase new policies frequently. Answer: B, ensuring the consumer understands the full policy terms and suitability before purchase. Explanation: ethical marketing and sales practices are crucial when selling long-term care insurance. Agents must ensure that the policies they recommend are suitable for the consumer's financial situation, health, and long-term care needs. Agents should fully explain policy terms, exclusions, and benefits to help consumers make informed decisions. A, C, and D are unethical practices and violate Illinois suitability standards and consumer protection regulations. Illinois long-term care insurance regulations. Ethical considerations and suitability. Question 10. What is the primary purpose of the Illinois Medicaid Estate Recovery Program as it relates to long-term care? A, to reimburse private insurers for long-term care claims. B, to recover costs paid by Medicaid for long-term care services from the estates of deceased beneficiaries. C, to provide additional Medicaid benefits to long-term care recipients. D, to limit the amount Medicaid can spend on long-term care services. Answer: B, to recover costs paid by Medicaid for long-term care services from the estates of deceased beneficiaries. Explanation: the Illinois Medicaid Estate Recovery Program seeks to recover costs paid by Medicaid for long-term care services from the estates of deceased beneficiaries. This applies to individuals who received Medicaid benefits for long-term care, and the state can claim assets from their estate after their death to recover these costs. This does not affect private insurers or limit Medicaid spending, but ensures that Medicaid funds are recouped where possible. Options A, C, and D do not accurately describe the program, Medicaid, and long-term care. Illinois Medicaid Estate Recovery Program. Question 11. In Illinois, what is the required minimum duration for long-term care insurance policies to provide benefits? A, 1 year. B, 3 years. C, 5 years. D, there is no minimum duration requirement. Answer: D, there is no minimum duration requirement. Explanation: in Illinois, long-term care insurance policies do not have a mandated minimum duration for benefits. Insurers may offer various policies with different durations based on consumer needs and market conditions. While many policies typically offer benefits for a range of years, no specific minimum is enforced by the state Illinois Insurance Code. Long-term care insurance requirements. Question 12. Which of the following benefits must long-term care insurance policies in Illinois offer? A, home health care services. B, hospitalization coverage. C, prescription drug coverage. D, limited nursing home benefits. Answer: A, home health care services. Explanation: Illinois regulations require that long-term care insurance policies include coverage for home health care services. This is a critical component of long-term care, allowing individuals to receive care in their own homes rather than solely in institutional settings. Options B, C, and D are incorrect because hospitalization and prescription drug coverage are not mandatory in long-term care policies. Illinois Insurance Code. Long-term care insurance benefits. Question 13. What is the primary function of the Illinois Long-Term Care Insurance Partnership Program? A. To provide state funding for all long-term care services. B. To allow policyholders to qualify for Medicaid while protecting their assets. C. To mandate all insurers to offer long-term care policies. D. To eliminate the need for private long-term care insurance. Answer B. To allow policyholders to qualify for Medicaid while protecting their assets. Explanation. The Illinois Long-Term Care Insurance Partnership Program allows individuals who purchase qualified long-term care insurance policies to protect a portion of their assets when applying for Medicaid. This program encourages the purchase of private insurance to help cover long-term care costs and assists in asset protection. The other options are incorrect because the program does not provide state funding. A. Does not mandate insurance offerings. C. And does not eliminate the need for private insurance. D. Illinois Long-Term Care Insurance Partnership Program. Question 14. In Illinois, which of the following provisions must be included in long-term care insurance policies? A. A guaranteed renewable provision. B. A non-cancelable provision. C. An exclusion for pre-existing conditions lasting longer than 6 months. D. A mandatory waiting period of 90 days before benefits begin. Answer A. A guaranteed renewable provision. Explanation. Long-term care insurance policies in Illinois must include a guaranteed renewable provision, meaning the insurer cannot cancel the policy as long as premiums are paid. This provides essential security for policyholders, while exclusions for pre-existing conditions are common. They do not have to conform to a specific duration. C. And there is no mandatory waiting period. D. In the regulations. Illinois long-term care insurance provisions. Question 15. Scenario-based. Mr. Thompson is 75 years old and is considering purchasing a long-term care insurance policy in Illinois. He has a pre-existing condition that he is worried may affect his eligibility. What should Mr. Thompson be aware of regarding underwriting practices in Illinois? A. All insurers must accept applicants regardless of their health status. B. Insurers may deny coverage based on pre-existing conditions. C. There is a 30-day grace period for coverage after application. D. Pre-existing conditions cannot be considered if the policy is for less than 5 years. Answer B. Insurers may deny coverage based on pre-existing conditions. Explanation. In Illinois, insurers have the right to evaluate applicants for long-term care insurance and may deny coverage based on pre-existing conditions. Insurers often review the applicant's health history during the underwriting process. Options A and D are incorrect because insurers are not required to accept all applicants and can consider pre-existing conditions regardless of policy duration. There is also no specific grace period associated with coverage initiation. See Illinois Long-Term Care Insurance Underwriting Regulations. Question 16. Which of the following statements regarding inflation protection for long-term care insurance policies in Illinois is correct? A. Policies must provide automatic inflation protection. B. Inflation protection is optional, but if offered, it must be specified clearly in the policy. C. All policies must include inflation protection regardless of the premium. D. Insurers cannot offer inflation protection as part of their policies. Answer B. Inflation protection is optional, but if offered, it must be specified clearly in the policy. Explanation. In Illinois, while inflation protection is not mandatory, any policy offering this feature must clearly specify it within the terms of the contract. This ensures that consumers understand their coverage options and can make informed decisions about their long-term care insurance needs. Options A, C, and D are incorrect as they misrepresent the state's regulations regarding inflation protection. Illinois Insurance Code, long-term care insurance, inflation protection options. Question 17. What is the maximum waiting period allowed for long-term care insurance policies in Illinois? A. 30 days. B. 60 days. C. 90 days. D. There is no maximum waiting period. Answer: D. There is no maximum waiting period. Explanation: Illinois regulations do not specify a maximum waiting period for long-term care insurance policies. Insurers can choose the length of the elimination period, which may vary widely among different policies, providing flexibility to both the insurer and the policyholder. Therefore, there is no set maximum limit. Illinois Insurance Code, long-term care insurance waiting periods. Question 18. What is the purpose of a suitability determination in the sale of long-term care insurance in Illinois? A. To ensure that the applicant can afford the premium. B. To guarantee the applicant will use long-term care services. C. To determine whether the policy is appropriate for the applicant's financial and health situation. D. To allow agents to charge higher premiums based on the applicant's assets. Answer: C. To determine whether the policy is appropriate for the applicant's financial and health situation. Explanation: a suitability determination is a requirement in Illinois that ensures agents assess whether long-term care insurance policy is appropriate for the consumer's needs, taking into account their financial situation and health status. This process protects consumers from purchasing unnecessary or inappropriate coverage. Options A, B, and D do not accurately reflect the purpose of the suitability determination. Illinois Long-Term Care Insurance Suitability Standards. Question 19, scenario-based. MS. Rodriguez is 66 and is considering long-term care insurance. After researching, she finds a policy that includes a 6-month elimination period. What does this mean for her? A. She can start receiving benefits immediately after purchasing the policy. B. She will not receive benefits until she has paid for her care out of pocket for 6 months. C. The insurer will cover her care costs for the first 6 months. D. She can cancel her policy without penalties within 6 months of purchase. Answer: B. She will not receive benefits until she has paid for her care out of pocket for 6 months. Explanation: an elimination period, also known as a waiting period, is the time during which the insured must pay for their care out of pocket before the policy benefits kick in. In MS. Rodriguez's case, she will be responsible for her care costs for the first 6 months after needing long-term care before the insurer begins to pay benefits. Options A, C, and D are incorrect interpretations of the elimination period. Illinois long-term care insurance elimination periods. Question 20. In Illinois, how often must long-term care insurance companies provide policyholders with a disclosure statement regarding policy features and benefits? A. Annually. B. Every 2 years. C. Every 5 years. D. At the time of purchase only. Answer: A. Annually. Explanation: Illinois law requires long-term care insurance companies to provide policyholders with an annual disclosure statement that outlines the key features and benefits of their policy. This ensures that policyholders are informed about their coverage and can make necessary adjustments if their circumstances change. Options B, C, and D do not align with the annual requirements stipulated by Illinois regulations. Illinois long-term care insurance disclosure requirements. Question 21. Which of the following is true regarding the sales training requirements for agents selling long-term care insurance in Illinois? A. Agents must complete a training program every 5 years. B. Agents are not required to have any special training. C. Agents must complete a one-time training program approved by the state. D. Agents must complete a training program every year. Answer: C. Agents must complete a one-time training program approved by the state. Explanation: in Illinois, agents who sell long-term care insurance are required to complete a one-time training program approved by the state. This training focuses on the unique aspects of long-term care insurance, ensuring that agents are knowledgeable about the products they sell. Illinois long-term care insurance agent training requirements. Question 22. In Illinois, what is the maximum premium increase an insurer can impose on long-term care insurance policies without prior approval from the Illinois Department of Insurance? A. 5%. B. 10%. C. 15%. D. There is no maximum. All increases must be approved. Answer: D. There is no maximum. All increases must be approved. Explanation: all premium increases for long-term care insurance policies in Illinois must be approved by the Illinois Department of Insurance, regardless of the percentage. Insurers are required to justify the need for any premium increase before it can be enacted, ensuring consumer protections. Illinois long-term care insurance premium regulations. Question 23. What is the purpose of the 30-day free look period in long-term care insurance policies in Illinois? A. To allow the insurer to review the applicant's health history. B. To give the policyholder time to review the policy and cancel it for a full refund if not satisfied. C. To ensure that premiums are not due during the first month of coverage. D. To allow agents to adjust the policy terms after sale. Answer: B. To give the policyholder time to review the policy and cancel it for a full refund if not satisfied. Explanation: the 30-day free look period allows policyholders in Illinois to review their long-term care insurance policy after purchase. If they are not satisfied, they can cancel it within that period and receive a full refund of premiums paid. This provision protects consumers and ensures they have a chance to reconsider their purchase. Illinois long-term care insurance free look period. Question 24. Which of the following is NOT, a required disclosure in long-term care insurance policies in Illinois? A. Information about benefit triggers. B. Information regarding inflation protection options. C. Guaranteed issue of coverage for all applicants. D. Information about exclusions and limitations. Answer: C. Guaranteed issue of coverage for all applicants. Explanation: in Illinois, long-term care insurance policies must include disclosures regarding benefit triggers, inflation protection options, and exclusions and limitations. However, there is no requirement for insurers to guarantee coverage for all applicants, as underwriting processes may still apply Illinois long-term care insurance disclosure requirements. Question 25. Scenario-based. Mr. Jenkins has a long-term care insurance policy that includes a 12-month elimination period. After 9 months of needing care, he seeks to use his policy. What will happen? A. He can immediately start receiving benefits. B. He must wait an additional 3 months before benefits are paid. C. He will receive partial benefits for the 9 months. D. He will not receive any benefits as he has not completed the elimination period. Answer: D. He will not receive any benefits as he has not completed the elimination period. Explanation: the elimination period is the duration during which the policyholder must cover their own care costs before the insurance benefits begin. Since Mr. Jenkins has not yet completed the 12-month elimination period, he will not receive any benefits until that period is fulfilled. Illinois long-term care insurance elimination periods. Question 26. Which of the following factors can lead to a denial of coverage in long-term care insurance applications in Illinois? A. The applicant's age. B. The applicant's income level. C. The applicant's pre-existing health conditions. D. The applicant's previous insurance claims history. Answer: C. The applicant's pre-existing health conditions. Explanation: insurers in Illinois can deny coverage for long-term care insurance based on the applicant's pre-existing health conditions. This factor is a critical consideration during the underwriting process. While age may influence premiums, it does not lead to automatic denial, and income level, B, and previous claims history, D, are not typically grounds for denial. Illinois long-term care insurance underwriting regulations. Question 27. What are the continuing education requirements for agents selling long-term care insurance in Illinois? A. 8 hours every year. B. 16 hours every 2 years. C. 24 hours every 3 years. D. No continuing education is required after the initial training. Answer: B. 16 hours every 2 years. Explanation: in Illinois, agents who sell long-term care insurance are required to complete 16 hours of continuing education every 2 years to ensure they stayed updated on regulations and industry practices. This requirement helps maintain a knowledgeable sales force. Illinois continuing education requirements for long-term care insurance agents. Question 28. Scenario-based. Ms. Lee is reviewing her long-term care insurance policy and sees that it includes a waiver of premium provision. What does this mean for her if she requires long-term care? A. She must continue paying premiums regardless of her situation. B. Her premiums will be waived for a specified period while she is in care. C. She will receive a refund of premiums paid during her care period. D. She can cancel her policy without penalties after 12 months of care. Answer: B. Her premiums will be waived for a specified period while she is in care. Explanation: a waiver of premium provision allows policyholders to stop paying premiums for their long-term care insurance while they are receiving covered care. This means that Ms. Lee will not have to pay premiums during the specified period when she is in care, easing her financial burden during that time. Illinois long-term care insurance waiver of premiums. Question 29. Which of the following statements regarding the portability of long-term care insurance policies in Illinois is true? A. Policies cannot be transferred to another state. B. Policies are portable and can be transferred without losing benefits. C. Policies are not portable and benefits are lost if the insured moves out of state. D. Portability is determined solely by the insurer. Answer: B. Policies are portable and can be transferred without losing benefits. Explanation: in Illinois, long-term care insurance policies are designed to be portable. If a policyholder moves to another state, they can often retain their benefits, subject to the laws and regulations of the new state. Therefore, option B accurately reflects the nature of portability in long-term care insurance. Illinois long-term care insurance portability regulations. Question 30. In Illinois, what must insurers provide to policyholders regarding long-term care insurance coverage at the time of policy renewal? A. A notification of premium increases only. B. A revised summary of benefits and features. C. A guarantee of no changes to the policy terms. D. A new application for coverage. Answer: B. A revised summary of benefits and features. Explanation: at the time of policy renewal, insurers in Illinois must provide policyholders with a revised summary of benefits and features of their long-term care insurance policy. This ensures that policyholders are aware of any changes in coverage or terms as they renew their policies. Options A, C, and D do not reflect the requirements for renewals. Illinois long-term care insurance renewal requirements.